The U.S. stock market has performed very well this year. Year to date, we're up 17%. This is an exceptional year. However, while the United States has seen tremendous growth led by mostly AI companies, the rest of the world has also seen incredible growth. So U.S. stocks have actually lagged global markets this year. This is a chart that demonstrates U.S. returns versus global equity returns. So if you were to invest in just the United States versus if you were to invest in just the rest of the world. If you had invested in the rest of the world, you would have made about 10% more than if you had invested in just the United States. So the United States went up 17%, the rest of the world went up about 28%, at least in 2025. Now, granted, the United States generally outperforms by very large margins the rest of the world. Generally, the United States has been a bastion of outperformance. Real quick primer, there are three kinds of markets. There's developed markets, there's emerging markets, and then there's frontier markets. These categories are used as shorthand for how developed a country is. So a very developed market like the United States is a market that has very high liquidity. There are very strong controls in place where you can catch fraud and companies aren't just like outright defrauding their investors. There's a lot of liquidity in these markets, which means that you can trade in these markets. You're not stuck in a position if you manage to get a position. Emerging markets, they're less developed than the highly developed nations like the United States, the UK, and all these. Emerging market economies, these are countries like Poland, like Chile, like China, and Hong Kong, Taiwan, South Korea. These are countries that are very quickly becoming developed, and they are bolstering the ability to invest in these countries. Frontier markets, of course, are the bottom of the barrel. These are your Irans, your Syrias, your Democratic Republic of the Congos. Frontier markets are very hard to invest in. They're very illiquid. They typically have autocratic governments. They're very scary places to invest. For instance, Russia, for a very long time, was considered an emerging market, and they've been downgraded to a frontier market because it turns out that the country can just come in and suspend all trading on the stock market. That's just not good. You just can't have that, you know. They were doing increasingly better, and then they just decided to blow it all up. Emerging markets are a great place to invest typically because you get a little bit more of the safety and security than a frontier market, but you still get a lot of that growth that you don't typically find in a developed market, unless you're talking about the United States, in which growth is forever and always. But anyway, a lot of investors like to flock to emerging markets, especially when the United States is sort of up in the air about some stuff, especially right now. There's a lot of talk about U.S. risk. The U.S. is becoming less and less a good place to invest just because of the sort of erratic nature of a lot of the policies that dictate what this country is actually doing. More and more investors are going outside the United States, and they're going to these emerging markets. As you can clearly see, this past year has seen wild outperformance on the global stage. The biggest emerging markets ETFs, 25% of the portfolio is China. So because China is sort of the largest of the emerging markets, it's obviously the highest weighted. So if you're going to run an index like this, you're going to invest in the countries that have the largest market caps. So China, of course, becomes the largest country in basically every emerging markets portfolio because China is the largest emerging market. It will very likely become a developed market in the next couple of years, despite the fact that it has been an emerging market for the last like 25 years. It seemingly can't get out of the emerging market status. You typically get like China and India and Brazil. They're pretty locked down countries. They don't exactly have a ton of freedom in terms of what people are allowed to do. And so there was a company that sort of recognized this, and they said, hey, what if we build an ETF that gets all of the emerging markets and we rank it by how free those emerging markets are? And so this is where Life and Liberty Indexes comes in. Disclaimer, I have followed them for a very long time. I am personally invested in the Freedom 100 Index. Basically, they said, hey, what if we go around to all the emerging market countries and we rank them by how free they are? Obviously, they're not doing any of the ranking. They're pulling data. So their investment philosophy, freedom weighting, quantitative, personal, and economic freedom metrics are primary allocation drivers in our investment process. Freedoms are interconnected. Civil, political, and economic freedoms work together and should be measured as a composite. And the other really cool thing about this ETF is they take out all of the state-owned enterprises. This almost alone makes it worth investing in because genuinely, maybe one of the biggest risks of investing in these emerging markets is Alibaba. They just disappeared the CEO at some point. He came back, obviously. Chinese Construction Bank Group is basically entirely owned by the Chinese government. Xiaomi, again, very heavily invested by the Chinese government. If these companies are are not directly owned by the Chinese government, they have massive loans that are from the Chinese government. And so there's some control that's exerted there, no matter what. And so that's a tremendous amount of risk that you're taking on, because it's like the country could just decide, especially with China, that they're changing things, and all of a sudden you have like Alibaba, great example of this. Alibaba was going to let Ant Group to go public. They have a finance division, which was Ant Holdings, and they were going to spin it off. They were going to IPO it. And the Chinese government basically stepped in and said, you're not going to do this. And so that led to a titanic fall, like 80%. Obviously, we saw Jack Ma disappear for like 9 months, and that wasn't great. Life and Liberty Freedom 100. There's 24 emerging market countries, and they rank them by how free they are. Obviously, these are some of the metrics: civil, political, economic. All of this data provided by the Fraser and Cato Institute, which you can go and you can read. The Human Freedom Index 2024. This is a report by the Cato Institute. You can go and you can read it. It basically pulls all this data and ranks countries based off of basically the same things. And you can see Switzerland is the most free country. This ETF does not allow you to invest in China at all because their human rights score is so low that you just get cut out of the ETF completely. Over the last few decades, emerging market stocks and US stocks demonstrated significant cyclical shifts in performance. One of the big problems with investing in emerging markets is sometimes they just kind of like blow up. Which isn't great. Like China. Yeah, sometimes, 2008, sometimes you just blow up, down 60%, 2020, down another, 40% or whatever. So if there's a big crunch outside the United States, especially if you get something like 2008, where the entire world's affected by it, then you get real big problems. A lot of emerging market countries trade at relative discounts, obviously, because they're emerging market countries. They have to trade at a discount. And obviously, the United States is going to trade at a premium because, it's the United States. And this is what I was talking about. You have the autocracy drag, and this is a sort of uniquely emerging markets well, not so much anymore. But case study number 1 of Russia. Once accounting for 10% of the index, Russia's weight has fallen to less than 2% by the time it was removed. At the end of the day, the market is a very powerful thing, and it's very hard to overcome just like market dynamics. And so when you have countries that try and come in and exert very strong levels of control over sort of the free market, it just doesn't work out. Case study number 2, China. China has become a large emerging market economy. Long-term returns to investors have been muted and volatility has been high, which is not great. I do not like volatility. I am a scared boy. China's annual returns, 2%. Max drawdown, imagine losing 90%. Meanwhile, if you go throughout the rest of the world, the annual returns is about 7%, and the max drawdown is 65%. So not only are you getting better returns by going to the rest of the emerging markets, but you also get less volatility. It's just a good thing to have. The countries with the most freedom tend to have the best stock returns, and the countries with the least freedom have the worst stock returns. Also, another sort of subtle thing, which is kind of cool, 8% cap on any security weight. So there's no single stock is more than 8% of the portfolio. And this is the difference between the two major, this is really important. This is the difference between the two major emerging markets ETFs right now. So MSCI's emerging market ETFs, EEM, I believe this is EEM, 32% of it's in China, 20% in Taiwan, 15% in India, and then 11% in South Korea. Whereas if you rank purely based off of how free the country is, you get Taiwan at 21%, South Korea at 19%, Chile at 19%, and then Poland at 12%, and Brazil at 7%. Also, your expense ratio is a little bit high. It's 0.5%, but I think it's worth it. You're getting better returns and less volatility. Also, you get a nice 2.4% dividend yield. It's a well-run ETF. Perth Dole is the founder. If you don't know, she's kind of a cool person. She's very knowledgeable. She genuinely, if you go listen to her talk, she really sort of knows what she's talking about. FRDM is at $51. Over the last 5 years, it's gone up 60%. It's had very good performance, especially over the last year, because it turns out the places where you want to be invested are everywhere that this ETF is invested in. I think it's worth taking a look at. I think it's worth potentially investing in, because emerging markets have long been a thing that I've been an advocate for. I've always said, hey, you know what? It's great that you can invest in the United States, and it's great that the United States has great performance over the last couple of years, but it's important to diversify, I think, outside the United States. The best place to do that, I think, is in the emerging markets. And so the best ETF that I have found personally is the ETF that tracks freedom. It says, hey, you know what? If freedom is your priority, you'll grow quicker. It is demonstrated over the last couple of years. That is indeed the case. And hey, if you enjoyed this video, let me know your thoughts on emerging markets, and subscribe if you're not already, and give the video a like. Come hang out live too.